Welcome to Brookfield Perspectives, a podcast that explores the Brookfield ecosystem's role in creating sustainable wealth on a global scale. On today's episode, we step back from transactions and trends to examine a more fundamental question. Where are we in the market cycle, and how could that shape the way we invest? Howard Marks joins Brookfield's Alper Daglioglu for a thoughtful conversation about investor psychology, risk positioning, and the balance between offense and defense. Here's their conversation.
Hi, everybody. I'm Alper Daglioglu. I'm head of Brookfield Investment Solutions Group. And today I'm joined by Howard Marks. Howard, great seeing you. You often say, we never know where we are going. We surely should know where we are. Before we get into specifics about the market cycles, investments, portfolios, I would love to start there.
Well, Alper, everybody in the investment business talks about where we're going. They would like to know where we're going. I would like to know where we're going. It's just that it's not possible. And actions taken in reliance on an expectation of what's going to happen a year or two from now are often wrong. But we should know where we stand. And I believe that where we stand has a lot to do with what's coming up. Where are we today? I think the most important thing to bear in mind, if you're interested in managing your portfolio with short-term or intermediate-term considerations, you can ignore this stuff if you say, I'm only interested in 20 years. But if you care about the short to intermediate term, short is 1 year or two, intermediate is, let's say, up to 3 or 5. I think it's important to note that in this market, optimism is in the ascendancy. I think that the main thing that changes from week to week or month to month or even year to year is the level of optimism versus pessimism. When optimism is riding high, prices are probably high relative to intrinsic value. Prospective returns are modest. Uncertainty, risk is relatively high, and that means we should behave in a more cautious manner. When pessimism rules, prices are probably very low relative to intrinsic value, so that means we should turn highly aggressive. That's the main dimension on which I think about managing money in the short to medium term. Is it optimism or pessimism? Should we be aggressive or defensive? And I think that optimism, after a very rough 2022, optimism took over in the fourth quarter. And as a consequence, for the last 39 months, the markets have been on a tear. The period 23-4-5 for the S&P 500 is, I think, the seventh best 3-year period out of the last 100. Seventh out of 100. And that tells us what's going on. It has implications for what's coming next. So I think that investors should bear in mind that today's market is dominated by optimism, that the world is unpredictable as usual, or maybe more so, and some of the rapid growth that we saw in the last half of the 20th century because of recovery from World War II, technological and managerial advances, globalization, etc., some of those growth factors are probably going to be less in the years ahead. So if you sum up prevalent optimism, unpredictability, and maybe moderate growth, I think you would say you have to invest carefully, and maybe this isn't the time for sheer aggression, rather for an upgrading of defensiveness.
Sure. As investors, one of our most important jobs we have is to really understand the importance of investment selection and risk positioning. I think what you said, risk positioning piece, it defined beautifully, but also as equally important, there's investment selection piece there as well. Can you put those pieces together for our audience? Like, how do you think about that?
Well, one essential trade-off in investing is between offense and defense. And the other one is between return maximization and enhancing predictability. Usually, the things you do to maximize return, you sacrifice on predictability. The things you do to maximize reliable outcomes, you have to give on maximization of outcomes. That's a trade-off. It's important to note that just because we don't know what the future holds doesn't mean we shouldn't take action. But I think we should emphasize events where the returns are more predictable and maybe de-emphasize maximization of return. That's what investment selection is all about. Everybody wants high returns predictably. It's just that they're elusive, and you generally have to decide which of those factors to emphasize. And the value investor, which is what I think Brookfield and Oaktree really are, emphasizes investments where the predictability comes from a superior understanding of what the future holds and specialization in a few areas, non-reliance on, shall we say, speculative technologies and intellectual property and things like that. I think that those are the important elements in investment selection today.
And going back to this balance between offense and defense, you wrote Nobody Knows. Really at the middle of the global financial crisis, I think the day was September 19, 2008, when everything felt completely unknowable. I remember personally sitting at my desk feeling like the entire global financial system is really collapsing, and it's like one after another, there is a domino effect. You always talk about how good investing often feels uncomfortable. And also you make the point, truly attractive valuations appear in environments marked by extreme fear, extreme uncertainty, and usually some forced selling. So in fact, comfort and good investing, they don't typically coexist. Can you talk about that dynamic from your perspective?
Well, Alper, what you're asking about leads to a great example of what I call second level thinking. September 19th of 2008, a couple of days after the Lehman bankruptcy, was certainly one of the most uncertain days in my almost 80 years. The only thing comparable was the low point of the pandemic in March of 2020, when the world was equally uncertain, and when I also wrote a memo entitled Nobody Knows. I recycled that title.
Yes.
So the question is not, is the future foreseeable? Of course, we think it never is perfectly foreseeable, and sometimes even less than at other times. But when people embody the feeling that you described of hopelessness and abject terror with the possibility that the financial sector will melt down, their negativity tends to make prices low relative to intrinsic value. And it's really the relationship between price and intrinsic value that we want to key on. It's obvious that when people love things and feel good and are optimistic and are happy and feel positive about the future, prices are probably high. When prices are high, prospective returns are low and risk is high. So when they feel the worst about the environment, that's probably the moment when the price is as low as it can be relative to intrinsic value, meaning that prospective returns are high and risk is low. And one of the ways I put it is that the riskiest thing in the world is the belief that there's no risk. So one of the safest things in the world is the belief that risk is everywhere, because it puts prices so low that risk is, shall we say, minimal. Now, let's talk about discomfort. If you committed to spend money, as we did on September 19th, and you're not uncomfortable, there's something wrong with you. It's only human to feel uncomfortable when you're staring into the abyss, but we have to do it anyway. And in fact, it's more important to do it that day than on the day we feel great. We have to master the courage to do our jobs. And what should make it easier for us, if it can be made easier, is the confidence to know that, as we were on September 19th, we're the only person in the world who will buy and everybody else wants to sell. And isn't that the perfect opportunity for the buyer?
Well said. An investment that we make feels easy or universally accepted, what should that be telling about the price?
When people are terrified, prices are at a minimum relative to intrinsic value. It's all a buy. When people are euphoric, carefree, prices are at a maximum relative to intrinsic value, and you have to be very cautious. If you embody the same emotion, or we may say psychology or investor sentiment, as everybody else, then you will fluctuate along with them. You'll buy at the top of a bubble, just like they do. That's how bubble tops get formed. You'll sell at the bottom of a crash. That's how bottoms get formed. And you'll do no better than the average investor. Our goal is to do better than the average investor. So we have to diverge from the average investor. In fact, optimally, we have to behave as contrarians. Buffett says most things best. He says, the less prudence with which others conduct their affairs, the greater the prudence with which we must conduct our own affairs. So if you think about it, it's nothing short of an oxymoron to say this is a bargain price security that everybody loves. When everybody loves something, it's unlikely that it'll be on the bargain counter. So if you're thinking about investing it, you have to be leery of the elevated nature of investor psychology. One of the most popular discussion topics today is AI, and most people think AI is going to change the world. I'm confident that AI will change the world. That's not the question. The question is how, when, with what impact, who will benefit?
I think it comes down to investment selection. Two investments, especially if you touch on AI, they are not created equal and they don't have the same journey. And maybe another thing that you always talk about, the most important thing is having the able to align yourself with asset managers or other participants who are specialized, who have done this before, or who are cycle tested in this type of assets, and they can still participate on the upside, but also your first principle, thinking about the risk management and also understand the downside. And I think that's what differentiates the good investing from not good investing.
Well, look, we all have our biases. Some of us are inherently aggressive. Some of us are inherently defensive. I'm so inherently defensive that I can't turn to aggression until I believe that the odds are overwhelmingly on my side. Each of us has to, as they say in football, play within ourselves. We have to do the things that come naturally to us. The chicken should not be assigned to do a daredevil feat. And the daredevil should not be assigned to carefully shepherd money. And the client might choose to hire some of each. And if they can find a brilliant aggressive manager and a brilliant defensive manager and put them together, maybe the aggressiveness and the defensiveness will offset or diversify each other, but maybe they'll end up with brilliance. And that would be a great way to go. So as you say, all investments are not created equal, and you have to have a good idea of what you want to accomplish. Not merely the fact that you want to participate in AI, but again, with what balance of aggressiveness and defensiveness? To me, that question underlies everything you ever do in investing, including or starting with asset selection.
Howard, one of the themes that runs through your memos and your investment philosophies also is the power of truly long-term investing. And from your experience, what are the biggest obstacles that get in the way of behaving truly long-term?
How much time do you have? That's the greatest question. It's probably the most fun for me to answer, but it's a big question with a long answer. Most of the elements of human nature are designed to prevent us from being good investors. When things are going well, the economy is performing well, companies are reporting record earnings, the stock prices are rising, people get more excited and they want to buy more of something until it reaches an apogee at which they want to buy everything. When things go poorly and the news is bleak and the prices are cascading downward, they lose heart, they want to sell, and when we approach what might eventually turn out to be the bottom, they want to sell everything. Well, that's the opposite of what you should do. You should buy low and sell high, not buy high and sell low, but it's against human nature. And if you get depressed and your enthusiasm for selling increases as prices fall, isn't that the opposite of what we do in every other walk of life? In every other walk of life, we buy more when things go on sale. In the markets, we sell more when things go on sale. So this just indicates the essentially wrong nature of investor sentiment. And then again, we have what we call the nonlinear utility function. Most people care a little about a dollar made and a great deal about a dollar lost. But exposing yourself to the risk of loss is integral in trying to have a good investment return. So even though our investment philosophy stresses risk control, we're not talking about risk avoidance. We're talking about intelligent bearing of risk, but people's psyches are warped to prevent them from viewing risk objectively. You have to take some risk in order to make money. So that's another problem. So investor psychology, human nature. Then we have something called institutional constraints. So if you're an employee, what we call an agent, and your job is to manage somebody else's money, what is your payoff structure? You make a good investment decision, you get a pat on the back, handshake, maybe a raise. Make a bad investment decision, you get fired. So that means that your incentives are directed more at avoiding losses than at achieving gains, and maybe to an extent which has a negative impact. So you have to overcome the institutional constraints. Dave Swenson, who ran the endowment at Yale with great success from 85 to 2020, said that investment management requires non-institutional behavior from institutions, establishing a conundrum that is not easily resolved. How can institutional employees, agents, act as contrarians, act as knowing bearers of risk for profit? And how can they increase their ardor for buying as prices fall rather than as they rise? Then the third factor, in addition to investor psychology and institutional constraints, is volatility. When prices fluctuate, especially agents, but even principals, get uncomfortable. So in the investment industry as a whole, there has grown up over the last 50 years, since I attended University of Chicago, a concept which was developed at University of Chicago, which is that volatility is risk, and volatility is to be avoided. I think that seeing prices fluctuate up and down is part of life. It's not a negative in itself. It's not to be avoided in itself. And if you are well-funded, you don't have to withdraw the money, you can't get a sell order from your clients, then volatility in itself is not to be avoided. And I think that the excessive nature of the concern with interim volatility is one of the wrongest things about the investment profession. Buffett again. Buffett says, I'd rather have a lumpy 15% return than a smooth 12. And I would say to people, if you'd rather have a smooth 12 than a lumpy 15, you have to ask yourself what's going on.
Look, it reminds me of one of the memo you wrote in, I think, late 2022 called What Really Matters. And there you gave the example as a kid, how we are told, don't just sit there, do something. And in investing, actually, probably we got to reverse that.
Well, I wrote that memo in October of 22 because I participated in a conference where everybody's question was, well, what month will the Fed stop raising interest rates? And I said, why do you care? This doesn't matter. What matters is whether we buy pieces of companies that grow in value and whether we lend money to companies that pay us back. And what month the Fed is going to stop cutting interest rates, or whether security prices rose by 1% yesterday or fell, doesn't matter. Yet these latter two things are the things that command attention. And that's largely because the things that really matter are determined in the long run. And once you make your commitment, you have to wait a long time to know if you were right. You have to sit there and not do something.
Sure. I want to come back to what you just said about the relative performance. And in investing, we always talk about how it's extremely easy to achieve average results, but also it's extremely difficult to consistently be above average. And in your Dare to be Great and Dare to be Great 2 memos, you wrote about that. To be great, investors must dare to be different, must dare to be wrong, but also must dare to look wrong.
Right. And when we talk about the things that interfere with good performance, this nails it. Dave Swenson used my favorite two-word phrase that good investing requires the adoption of uncomfortably idiosyncratic positions. You have to dare to be different from others. It's obvious that if you invest the same as everybody else, you can't be superior.
Well said. I just want to jump to one final topic, given we are coming up to the time. If you take a giant step back, think about with your experience, 57 years in the business, in the asset management landscape, change dramatically over the last 57 years. And it feels to us that change even accelerating further over the last 5-10 years. It feels like we are on doorsteps of something really major in terms of how the public markets and private markets and alternative investment, traditional investment, all those different pieces getting a little bit more converging to similar direction. Can you provide with our audience your view about the general asset management landscape and what are your views about where the puck is going?
Well, it's a complex question. I think the important thing is that the things that matter never change. Understanding the nature of investor psychology, institutional constraints, overemphasis on volatility, those are not going to change. The importance of risk control, consistency, non-reliance on forecasting, these things never change. Investors are always looking for the silver bullet that will permit them to make a high return without bearing risk. That will never exist. Superior investing will always be a matter of superior judgment, which is always, in my opinion, going to be personal and not machinable. That's my hope. But there's a lot of discussion now centered primarily around increasing the exposure of non-institutional investors to private asset. And private assets are not exchange traded. They're not liquid. You can't get out the day you change your mind. Sometimes you can't get out at all until the investor, the manager, concludes the process and returns your money. And there's no trading taking place. So when you buy the asset, you don't have a reference point that tells you that other people think this is the fair price. So there's a lot of uncertainty associated with investing in private assets. There are also great pluses. You get to buy things other people aren't. You get to buy things that don't mark to market and consequently don't demonstrate volatility and people don't get fussed about. Every stock is posted on the stock exchange every day. These are assets that maybe your manager can find that other people can't find, or maybe your manager can understand that other people can't understand as well. So there are advantages and disadvantages in private investing, and you have to take a sober view, and you have to only do the amount of private investing that is right for you. You should only do it if you understand what you're doing, and if you're sure your manager understands what he or she is doing and embodies your views. The easiest thing to say about investing is that there's nothing that's right for everybody. And if you combine that with the fact that there's no silver bullet, that means what you said earlier. Investments have to be chosen with care in each case, asset selection.
And you and I, we spend a lot of time meeting with our most sophisticated and largest clients around the world. And it feels to us that there is also a broader trend where investors and asset owners and allocators are looking to have smaller number of relationship, meaning smaller number of asset manager relationship or general partner relationship in a private sense, but more deeper strategic thinking about different capabilities and integrate something, thinking about not just the next vintage or next year, but thinking about the next 3, 5, 10 years, trying to solve the things that they try to solve. Could be asset liability, could be liquidity, could be other objectives they may have. And basically building a relationship where they feel like the asset management or GPs are almost like an extension of their broader organization and teams. I would love to get your take on that.
Obviously, the ideal condition would be to find a manager or a stable of managers who understand and reflect your point of view, are capable of giving you performance that will fit your needs and make you happy, and have the skill to do so. As you say, most people want to do more with fewer managers these days to simplify their lives and try to find those managers who will do the best job of giving them what they want and need. And there's no magic number. Just as in asset selection, with manager selection, we concentrate to take advantage of what we believe. We diversify to protect against what we don't know. And we have to strike a balance. Very few people have one manager, but we know that if you have 1,000 managers, you'll have average performance. What's the magic number? A lot has to do with having the ability to select the right ones. If you can't select the right ones, you might want to diversify heavily. If you can select the right ones and find a few that really appeal to you, then you might want to concentrate heavily. Institutional behavior dictates diversification of managers, but I can tell you that the clients we've had who have been willing to concentrate have had the best performance. But of course, this is another decision for which there's no magic solution. All these things, in the end, come down to judgment and insight.
That's great. Howard, as always, thank you for your insights.
My pleasure.
Thank you for your time.
Thank you.
Thank you.
Thanks for listening to another episode of Brookfield Perspectives. Make sure to follow us wherever you listen. You'll be the first to hear when new episodes drop.
The information contained herein is for educational and informational purposes only, and does not constitute and should not be construed as an offer to sell or a solicitation of an offer to buy any securities or related financial instruments. This material discusses broad market, industry, or sector trends, or other general economic or market conditions, and it is being provided on a confidential basis. Opinions expressed herein are the current opinions of Brookfield, including its subsidiaries and affiliates, and are subject to change without notice. Brookfield, including its subsidiaries and affiliates, assumes no responsibility to update such information or to notify clients of any changes. Any outlooks, forecasts, or portfolio weightings presented herein are as of the date appearing on this material only, and are also subject to change without notice. Past performance is not indicative of future performance. Copyright 2026 Brookfield.
Audiation.